You're listening to the Reinvest Podcast, where each Tuesday we show business owners and entrepreneurs how to diversify into real estate by equipping you with the tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo. Hey guys, another great day and another great episode on the Reinvest Podcast, where we bring you all things real estate investing so that you can arm yourself with the tools, the tactics, the strategies of what's going on out there in the wide world of real estate.
I feel like I have a second lease on life with how good the weather has been.
Yeah.
Like you walk outside and, you know, everybody that's not in like a cold place 6 months out of the year, you don't know what I'm talking about. But everybody that does know what I'm talking about, you just like get outside and you're like, oh my word, where am I living now? It just feels like you're in a different world.
I know. Well, you know what? The guests on our podcast here today also can empathize with that kind of crazy weather. With us today is Nicolas. Did I say your last name correct?
Yeah, perfect.
Let's go. Nico, how you doing, man? Thanks for coming on the show today.
I'm good. Thank you guys for having me on. It's definitely a sunny day in Chicago here, so
Chicago, yeah. So
indoors.
Yeah, you know about the cold.
He knows all about that windy life, you know, the windy city. I was in Chicago once, went to the top of the Sears Tower, flirted with a girl in 8th grade year. It was a great time. So other than that, I have no other affiliation with Chicago other than Giordano's Pizza. Come on.
Yeah, deep dish, I'm assuming.
Deep dish. Are you a Giordano's or a Lou Malnato's guy?
Honestly, I'm neither. I'm not a fan of deep dish, on the contrary.
Ooh.
Okay, we're going to redact that statement. I'm just kidding.
Yeah, we'll edit this podcast out.
That's funny. That's funny.
If I were from Chicago, I mean, I'm originally from South Florida, right? So we like a lot more of the New York style pizza down there, more thin crust or, Napoleon style, if you will, where I frankly think that's better than deep dish. A lot of people hate me for saying that if they're from, Chicago and think otherwise, but I just, eating deep dish, it sits like a brick in my stomach and I'm knocked out.
You got to be ready. You got to be ready to be done for the day.
It's like when you go to a Japanese steakhouse and you just Brazilian steakhouse, you got the meat sweats and you just kind of sit. Anyway, this whole conversation's got me hungry to talk about real estate investing and insurance today, and we'll give you a little teaser here later. But Nico, real quick, give us kind of a background story. How'd you get to where you are, and tell us about what you're excited about.
Yeah, so my origin story, as everyone can probably imagine, nobody wakes up as a kid one day and says, "I want to be an insurance agent." When I grow up. So, I started off being an athlete by trade, came up, worked my way through the ranks, was playing collegiately.
What was your sport? What did you do?
I played baseball.
Oh, nice. South Florida. Should have guessed.
Played for, a few colleges down in South Florida, right outside Miami. Smaller schools, but, could still pack their punch. And, came time to decision to evaluate, hey, do I want to keep doing this? And, kind of take the chance of getting drafted, playing 6-7 years in the minors, seeing if I make it all the way. I knew I wasn't a Bryce Harper or, one of those guys who'd be signing a multi-million-dollar deal, right, straight out of the gate. So decided, hey, it's not really for me. I think I have more passion and skill set for something else. Didn't know what it was at the time. But I started just exploring as much as I could my senior year of college and seeing what was out there, what I could add value-wise to the world. I was a finance major, so that ended up working out pretty well.
Nice.
For where I ended up. But I initially took a draw on a big curiosity to the tech world. So on campus, they had imagine like a startup accelerator program for college students where you can come in, pitch an idea, and they'll kind of help you take it from 0 to 1. And at the same time, there was a lot of local companies that were headquartered in South Florida that would participate and kind of headhunt right out of there, if you will, poach talent, whether it be developer, business development, anybody who could, give you some inkling of, hey, this person likes taking things from 0 to 1, right? Starting up companies, starting up products. So I was poached by a company called Kaseya. They own the naming rights to the Miami Heat Arena, if you're familiar, but they're a big IT firm headquartered in Miami. One of the largest, they were a unicorn before unicorn status was a big thing in the tech scene. So worked for them. I got hired March of 2020. And then a week later, the first COVID case hit in South Florida. So I was pretty much the first employee out the door once they started making their cuts.
Crazy.
And I was like, awesome, right? The first job experience, 3
Yeah.
months in, I pretty much went through all the corporate training, and they're like, "Sorry, we got to make cuts."
They're
And then
like,
from
thank
there,
you
I
for
was like,
joining us. And there's the door.
yeah. So, but they did teach me all about right software technology, really enterprise sales, right, dealing with large corporations and big enterprises, which was great. Right? It gave me a lot
Yeah.
of experience for
It's a lot.
dealing
It's
with
kind of a
really,
niche skill set to learn.
yeah. And I was just pretty much flat on my feet. I met a girl at the time, turned to be my wife, where I was like, I can't afford to pay for dinners on the weekends for two people. So let me find anything that I can do that would give me a job opportunity. And my best friend at the time, he goes back, they're like a third generation insurance family. So anytime there's like an emerging market, a new risk that's forming in the US, a lot of carriers rely on deep relationships of brokers who have done that before to roll out new insurance products to market. So I got really fortunate when COVID came through, right? The world shut down except for Amazon. Amazon really blew up. They were rolling out their delivery network across the US and all 50 states, and they needed somebody to insure them. So the firm I worked with essentially was given a contract by a few large insurance companies to kind of test the waters out, if you will, see how the market did. And then they kind of roll on a 5-year basis where they see, hey, after 5 years, let's see how it does, if it's profitable, because insurance is a future-based product, right? It's not a hard fixed cost where you know how much it's going to cost you to actually sell the product. So had to wait for some claim rate activity to develop, see what it looked like. And the market really fast became exactly what Florida and California on the homeowner side is running into now, where carriers said, hey, this doesn't work for us. We don't want to play in this space. And Amazon was sitting on 80,000 vehicles across the country that from 1 month to the next might not have insurance across the board. So we had to pivot really hard, figure out a scenario where I'm having conversations with my customers and saying, hey guys, sorry, your carrier doesn't want to insure you anymore. You might have to shut the business down, fire hundreds of your employees. And
this is because I'm a little ignorant, but I'm assuming that happened because as they got out on the roads, it just seemed like there was probably a lot more incidents or accidents that were occurring than maybe what they had estimated on the front end. They're like, hey, we're paying out way too much in claims. This is not an investment, so to speak, that we want to be involved in. Or what happened?
Yeah. So unfortunately, the hard part of insurance, it's not the physical property, right? People know how much it costs to fix a van or, right, if it's a total loss, there's a hard ceiling on how much that can cost an insurance company. What insurance companies don't know is more so the liability side, right? If a personal injury attorney gets involved, they don't know how deep that market can go until you're in it for a few years, right? So a lot of what pushed a lot of the carriers out was, hey, personal injury attorneys would pretty much follow these Amazon vans. And if they would get into an accident, they would literally hand a business card to the person who was on the other end of it.
No way.
To the point where it got really
What a
bad on the
business
fraudulent
model.
side. Right. Yeah. They made a ton of money, right? Insurance company claims fund personal injury attorney billboards. That's, the best way to essentially phrase that type of market. So
Disney makes
it
them
became
pay.
really difficult.
Yeah. Insurance companies hate them. Yeah, all those billboards.
I know it's difficult, but what it did is it opened up my eyes in terms of like, hey, this is probably the worst case scenario in terms of, type of fraudulent activity or just litigation cost when it comes to managing and running an insurance company, to the point where once we finally pivoted and found a solution where the only option was to essentially group all of our customers together and say, hey guys, we're going to build an insurance company around you. We're not going to go and source insurance from a third party entity. You guys are now the insurance company. We're going to build it around you. And lo and behold, it ended up turning out to an amazing product that after 2 to 3 years, people started to get an actual return on their insurance premium.
So you guys came up with kind of a profit sharing insurance company, kind of like a credit union, or like people have a fractional interest in the insurance companies that they have their policy with or something.
So there's a lot of ways where you can kind of describe it. I think the one that aligns the most with real estate, it's almost like a syndication group where, right, people come together, they put their money in a fund and they go out and they try and acquire an asset and then they share, right, the profit or the revenue share from that accordingly. But in this case, instead of the asset being a piece of real estate, it's an insurance company, right? And your pro rata share is what I pay for my insurance premium essentially equates to a future profit stake of the insurance company that is not only insuring my building, but that I also simultaneously own itself.
So that
So it's
ended up,
really
that
cool.
model you're saying ended up working for this whole Amazon logistics, all these Amazon drivers across the nation. This worked.
It did. Yeah. Because insurance companies, they like to have, right, they have their costs, but they also like to pad in profit margin. It doesn't have to be a lot, but sometimes it's enough when you're dealing in a large enough volume, right, of insuring an entire logistics network. The companies we were insuring were generating revenue for the insurance companies we had on the back end. They just weren't making enough money.
Gotcha.
So that opened up my eyes to say, hey, insurance company, you're making money. Why don't you want to stay in the space? And they said, sorry, we're just not making enough. We'd rather, right, put our risk elsewhere. We can see a higher return on our investment. So that really kind of rubbed me the wrong way, where I'm like, man, you guys, yes, you're making 5% profit margin off of, you know, three, four, $500 million of premium floating through. That's not enough, I guess, for them. So they decided to back out. But if you could take that model and say, hey, if there are other insurance products that maybe there's more, right, fat on the bone, where carriers are making 40, 50, 60% profit margins, that opened up the door where if you can apply the same business model to those scenarios, I mean, imagine what that would look like for an industry like real estate, where renters insurance, right, is the most profitable insurance product that exists on the market, right? Average
Really?
65%
That's
profit.
the, how many percent?
65% profit margin.
Just because
on
the
renter.
claim volume's so low?
Yep.
Wow.
We when we were evaluating, hey, what market do we want to go into? Once I realized that business model existed, I pretty much said, hey, this is something everybody needs to, one, be aware of, right? Because the traditional insurance route, brokers don't even know about this stuff. I didn't know about it as a broker myself until my business was essentially on the line, where we had to get creative and build something like this, right? So even your traditional State Farm insurance broker, they might be aware of this model, but they have no incentive to create it or sell it, because what's working now works. Why would they change it? Right. So once I understood the dynamics of the markets and, hey, these products are, right, captives, risk retention groups, profit sharing based insurance products have been around for centuries, but they've just never worked their way into the average investor, right, frame of mind, or they've never been put into perspective for, right, average insurance markets, because traditional insurance companies had no incentive to do that. Their broker networks that sell insurance products had no incentive to tell people about it.
Yeah.
So it never just worked its way through to your average person who pays for insurance today.
Right.
So you guys applied this model to the car business, Amazon logistics. It worked. And then I know through this conversation, we kind of melted into the property side of things. But just to make it clear for everyone listening, you're saying that you guys developed another company around this that specifically was for real estate investors?
We took the same model of allowing delivery companies to self-insure themselves and applied that same model to the real estate industry. And that's essentially what InsurTech is doing. So, right, we're going after owner operators, real estate investors, even property managers themselves. Anybody who's involved with owning, managing, or a stakeholder in the real estate industry, we're taking all of those insurance dollars from traditional companies that essentially leave the industry through profit margins every year. And we're closing that loop and ensuring all that profit that's being generated from the people who actually take on the risk themselves, and ensuring you guys are the ones that end up with that profit at the end of every year.
So what was the initial response, and who kind of the ideal property owners for this type of insurance policy?
Yeah, so we started off in the resident space, again, just because real estate is a very risk averse industry. People don't like, there are some people who like being an early adopter and testing out new things, but a majority of the market doesn't like to take risky bets. So we had to come in and we formulated the entire business model of proving a case study that we could show the industry, hey, insurance makes money. It can make a lot of it if you do it well. Here's a case study and a model to show that. So that's why we started off with renters insurance, because it was essentially our Trojan horse into the industry,
Yeah, it's
where
smart.
we worked around some larger property managers who didn't have, there are renter solutions in place today for the market,
Mm-hmm.
but they're all pretty much vanilla cookie cutters, offer the same thing. So we found a property management company. They had about 25,000 single family homes across the U.S. that they manage, and they said, "Hey, we would love to test this out in our communities and our homes. We'll essentially give you our network, insure our residents, and then we built the program around that specifically 3 years ago." So we incubated it. It turned out the average door that we were insuring was generating between $100 to $200 in added NOI, pure profit potential for the homes and the property manager we were working with. So we built the model out with them, showed them, hey, insurance makes money, right? Obviously, it's a long tail game. So we're in this for the long haul to ensure you guys are generating these returns consistently year over year.
So can I
And once
pause
we
you for
prove
a
that
second?
model, yeah.
You'd said that, and it kind of went over my head, but I want to bring this into the forefront. You'd said that these property owners started to make $100 to $200 more per door per year because of the implementation of the renter's insurance. How does that work?
Yeah. So most lease obligations carry a renter's insurance liability portion,
Mm-hmm.
right? Where every resident who moves into a property, they have to carry $100,000 limited liability policy to move in,
Yep.
right? The average cost for that is about $15 a month, right, to insure. So it nets out to be about $180 a year. But what most people also don't realize is that residents also pay for insurance other than the minimum required obligation that they're required to have in the lease, right? So think of their own furniture, their own personal belongings. A lot of companies will pay for a liability policy, right, to Lemonade or whoever the property management company uses, and then they'll go and get a second policy from their auto insurance provider to insure their own belongings, right?
Gotcha.
So renters are really on average spending closer to $20 to $30 a year or $20 to $30 a month in insurance costs, but property managers aren't aware of that, right? We kind of shine a light on that a little bit and said, hey, if your residents are paying for any insurance product, we want to make sure it's with our program because they're living on your asset, right? You're maintaining and managing all the risk of managing that resident. You should be the one to benefit from any profit that's being generated on this asset. So we went and insured furniture, their personal belongings. We can even insure pets.
So
right? That's a big product.
How does that translate to the NOI?
Yeah, how's the profit end up back with the owner of the property? Like at the end of the year, you give them a rebate, or is it a monthly distribution, or what does that look like?
So in the scenario you use, right, if a resident's paying Lemonade for liability, they're paying State Farm for their personal contents. Imagine if the owner of the asset owned both of those insurance companies, right? So those products, if they generate a return, it ends up back into the ownership's hands because the residents are essentially paying the insurance company, right, that we're building, that we manage and operate.
Yep.
And they essentially effectively own all the profits too at the end of the year. So it operates like a true independent insurance company, but really just plugging in our platform to insure residents through it. It's presented as essentially plan A. So right in the lease, we essentially tell residents, hey, you have to have an insurance policy to move into the property. It's already included. It's just $15 added to your rent. You don't have to go get insurance from Lemonade anymore.
So InsurTech right now exclusively offers renter's insurance to property ownership.
Not exclusively. That was just our foot in the door in the industry. We also now insure pretty much anything other than industrial properties. So we can also insure the property itself. We can insure commercial properties, whether that's office, retail, self-storage, and we can also do the same thing for operating insurance costs. I think workers' comp, think D&O, E&O, EPLI. The goal is to take any insurance dollar that flows through the real estate industry and put it in a profit-sharing vehicle to maximize the NOI across the industry as a whole. Each one of these individual cells, right, resident cell, owner cell, operator cell, everybody pays for a layer of insurance to protect their own liability. We want to make sure all that money ends up back in the real estate industry's hands instead of leaking out across every layer out to third-party insurance companies.
So one of the, as a property owner, one of the unseen kind of partners that really dictates some of the decisions you make with your property is your lender.
Yep.
And so early on, did you have a hard time getting lenders on board with this concept to look at you guys as a viable insurance option?
So most lenders, they really just verify reinsurance on the back end, right? Those are the real insurance players. So we waited or held off on going into the property market to understand what the requirements were. So as we started the rollout of the resident insurance program, we were building the property behind the scenes, figuring out what the regulations and requirements were for lenders. So that way, when we rolled out the property sell, we could just essentially hit the ground running and didn't have any hoops or hurdles to jump over once we hit the market with it. So yeah, all that stuff, right? We're approved already with Freddie and Fannie. We work with reinsurers on the back end. Essentially, reinsurance insures insurance companies, right? Most people don't realize that part of the equation, where they think, oh yeah, I pay State Farm my premium, right? But they don't realize State Farm also pays somebody an insurance premium that's just a lot less than what you're paying State Farm, right? That's the real cost of insurance.
Insurance arbitrage.
Yep, exactly. That's the heart of the model.
So like, just at the simplest form, property owner, I have a 100-unit apartment building. I'm going to get insurance through you guys. How does that look realistically as far as a distribute? Like, how does that save me money going through you guys? Does it look at, hey, if the company had a good year, I get a rebate? Or B, does it just look like my insurance rates are just lower than the average if I would go to another company like State Farm?
Yeah, so it does look like essentially a rebate at the end of the year. The formal rate, it is a profit distribution. Yep. Because it is recognized as a form of profit from the insurance company. But what we do is we'll take an example of a 100-unit property. If we get 80 to 90% of those residents to essentially pay in average $150 for the year, so you're looking at $15,000 for that unit or for that property. That essentially trickles back down into the ownership's bottom line at the end of the year. And then you take the property level, right? If they're paying $20,000 for that property, we're going to hold on to all those funds between you, your residence premium. We're going to pay out claims that accrue throughout the year across the industry as a whole, right? We can isolate to individual cells if we needed to. That tends to really only work if you're talking 10,000 units or more, like these large institutional REITs that have hundreds of thousands of units that they own nationwide. But for your average investor who's owning or managing 100 to 10,000 units, it's really hard to spin up your own individual captive, which the traditional route is for most of these types of programs that exist today. There really wasn't a vehicle around where smaller players can get together and essentially co-op their insurance and their risk together. So that's essentially what we structured, where we can pool everybody together who's in that ballpark of 10,000 to 100 units, bring everybody together, keep all the insurance dollars in-house. And on average, we're returning about 20 to 30% of all insurance dollars across the board. Wow. When you blend the average back to ownership, just because that's there is a return, Renter's insurance, it's 60% profit margin, Property level insurance, it's closer to 10 to 20%, but the average blended equates to about 30% of. Yeah. And you can write it off however you want, You can say, hey, it's a net reduction in insurance costs because technically, yes, you're paying for the money now and then you're getting a return on the back end.
Right.
You can roll that return that you get on the end and say, hey, I'm just going to roll this over into my future insurance cost where I'm going to reduce my out-of-pocket expense for next year's insurance premium because I can take that profit now. And instead of collecting it to then invest in repair or delayed maintenance, I can just keep the money. That just, that's my down payment for next year's policy. And I don't have to come out of pocket, for my future renewal cost. And it kind of just starts to pay down future capital than, paying for it now out of pocket. So there's a lot of ways you can slice it. It really is up to you. Some people will take the profit distribution at the end of the year and go, invest it somewhere else. Some will say, great, I don't have to pay for a down payment for my future insurance policy. Keep that 20% that you would have given me back. And now I just need to pay for 3 months from now. I can start paying my this year's current insurance policy.
So one more question before we jump into our show segment. At what level like do you need to be at as a real estate investor? How many units is ideal for a policy like this? Does it work for 10?
So
Someone that has a 10 unit building.
on the resident cell side, we really like to say, 100 units is
Mm-hmm.
the ideal minimum. We can go lower than that if it's if it's a class A building where some residents would rather pay for a 300,000 limited liability. It all boils down to, hey, what's the likelihood of profitability, right? Because if we welcome people into the program, we want to make sure they're adding value and a net positive return for the rest of the group, not taking away and hurting our profitability. So, we can say, hey, if you've got 50 units, but they're, class A, or you're in a high income, community where people, instead of just paying the bare minimum of 100K limits of liability, they'll add some additional products, and they'll spend, instead of $15 a month, they might spend $50 a month, to the point where that's going to be a profitable product. So on the resident side, 100 units, if you're class A or high income earners, we can go below that and bring you in. There really isn't a limit on the property side. The goal is to be fair for everybody. The only requirement is just, hey, the property has to be in an LLC name, right? So this is for an investor group. This isn't for people to insure their personal home. There's really no requirement on the property side of what we can and can't bring on.
Gotcha. All right. Well, that's interesting. Thank you for sharing that, explaining that. My brain was trying to wrap my head around how that would work realistically, and I think you did a good job at kind of breaking that down for simple people like me. And we are going to jump into our Smaller Pockets show segment. So, Nico, go ahead and tell us about a deal that went wrong. So it could be a deal that you were a part of personally, something in your business. What went wrong? And then more importantly, what did you learn from it?
I mean, early on in my career, when we were still building this model out with the Amazon Logistics Network, unfortunately, there were a few of our customers who didn't meet, we couldn't build a product fast enough to be able to insure them. So, early on, it was really hard having that conversation, where I did have to tell, three companies, hey guys, sorry, we can't insure you. We tried our best. And, a really hard thing early on that I realized is just having those really hard conversations, although they're difficult. And when telling somebody, sorry, you have to shut your business down because there's nobody wants to insure you. It really connects you to somebody, and getting in something that, it's really vulnerable. There's no other way to slice it, where, this is somebody's livelihood. This pays for their family. They're employing, hundreds of drivers that are out there on the road that, they then feed their own families with. So having those really hard conversations were really, really difficult and eye-opening for me, where it really put into perspective that, insurance is one of those things for a lot of people. It's kind of just like a necessary evil, where they're like, hey, I'm just going to pay my insurance company, and I never want to talk to them for the year. Hopefully I never file a claim. But having that conversation and putting insurance into perspective of how important of a product it is for some people, really gave me the perspective that this is something that really matters at the end of the day. I tried a lot of things when I was, figuring out what I wanted to do with myself. And, I started trying to drop ship, products, that was a big thing back in COVID, where, I would buy it in China and just sell it. And I was like, man, I'm selling something that somebody might just throw away in 2 weeks and not care about. This isn't something that's really serious. And it was just a complete 180 when having these really deep and serious conversations with people on a product like insurance. And that just really drove a lot of impact and passion for me behind it. Again, I know we started off and how people don't wake up and say, I want to be an insurance agent when they're a kid. But when you realize how awesome of a product this is and how much it means to people, it really is something that if you just work at it, and you, obviously have to have deep conversations to realize that, and how deep of a product it is. It really drives me a lot to try and find solutions to help people, to ensure I don't ever have to have that type of conversation ever again.
Yeah, that's a unique position where you're being the bearer of bad news in a way where it's like, hey, you can't get any, we were the only option and we can't help you. Yeah. And therefore you can't operate legally anymore. You know what I mean? And it's like
kind of crazy that there wasn't some other company that was willing to take it on. Those are big accounts, and I feel like people bet on Amazon kind of, at a high level, but The difference
in the homeowners market now is that the delivery companies couldn't go to the E&S markets, at least the ones that were insuring are working with Amazon. So right, if a traditional carrier backs out of the homeowners market, you've got E&S, or there's a lot of state funds that are building stuff to still insure people, but there wasn't a backstop right in that scenario. So it was a really niche product where most markets won't run into that problem. It was still early in its development, which is I think why we ended up in that position. But necessity is the mother of all creation, which is why we're able to now do this for the real estate industry.
All right, man, we're going to retool a little bit here and go into what we call our little nugget. So, Nico, this is the part of our show where we're going to pivot a little bit, set aside the insurance, and we're going to talk about you. We're going to talk about what's something at your core, could be an unwritten rule, a principle that really kind of personifies what you would say is attributed to your success.
Man, yeah. There's a ton. Obviously my faith is a big one, and starting your own company, it requires a lot of faith to know, you're going to be able to make it out on the other side when you have no idea where to start. But I think the core principle that I like to remind myself of is really just that action creates information. And when you're starting something new, obviously you don't have all the pieces. You don't know what tomorrow is going to look like, but at least doing something today is going to get you one step closer, or something is going to be uncovered where it'll lead you to, how do I start tomorrow now? So just always starting from the principle of, hey, if I just do something, it will teach me something that I can then build off of for tomorrow. And just always going out there and just acting, not trying to figure out and realize I have to have all the pieces and put the puzzle together before I can finally say I'm going to start. So I think just living by that has really helped me a lot. Especially
I like that. Action creates information. I think there's different ways that could be phrased, and everybody
I think there's
has some different stuff.
Similar stuff out there, but I love that principle of the best way to figure it out is just to go do it. And I don't know if it was you that said this, or your father-in-law, or if it was somebody else.
It's probably me. It's probably me.
But you can't steer a ship that's not sailing.
Oh, no, that was him.
Okay, your father-in-law. And you can't autocorrect or course correct or grow if you're not even trying, if you're not even moving. And so I love that.
Yeah. Elon Musk, he says, you got to have the failure feedback loop, right? You fail, you get feedback, you reiterate, you try again. And we all have to fight that. I'm convinced that, 5-10 years from now, all three of us are going to look back and be like, man, I don't even think we did it enough. We probably held back from trying some things that we were, nervous of going after. So that's awesome. Awesome. Okay, man, we're going to land the plane here. Just a couple of things. What's been one of the best resources in your business development?
Man, there's a lot. I try to consume as much information as possible. I also am a visual learner, so I tend to search YouTube a lot before I go down articles, just because I can consume content right at 1.5 or 2x speed.
I was just gonna say you look like one of those freaks that listens to Audible at 2x. Yeah.
YouTube was really a good resource in the beginning. Just hearing people's the big successes, starting in the startup scene, you follow the Zuckerberg and the Bezoses of the world and realize that, man, these guys built these awesome companies right out of a garage in Bezos's case, and hearing their story and just kind of picking pieces of how you could apply it to your own. So YouTube was really helpful early on, but I think the biggest thing was just working with people who were ahead of me and listening to their advice. So obviously when you're starting out, or even when you're doing anything, when you ask questions, a lot of people will give you answers, but really kind of picking and choosing who you want to listen to. And it's always typically somebody who you want to be in their position in the future. So relying on those people who I admired, or I wanted to be like in the future. I think they were a big part of who I am today, and the mental models and frameworks that I use and apply to not only my life, but my business as well. So relying on mentors and people who were, just ahead of me. And honestly, I got to thank them always, obviously, for giving me their ear, letting me talk to them, giving me 5 minutes out of their day. I'd say those people have been really a big impact on who I am today and where I'm headed.
Find somebody who is ahead of you. I like that's good advice. Nico, where can people find out more about you, follow your success? They're a property owner. They want to have a conversation about InsurTech.
Yeah, I think my website's the easiest place to start. InsurTech.com, INSUR3tech.com.
Mm-hmm.
I'm very active on LinkedIn. So if they look me up, Nicolas Lares, I'm always active on there posting, insurance insights, and how to start thinking about just paying for insurance to now owning an insurance company. Yeah, I think those are the two best spots.
Awesome.
Well, we're going to put those things in the show notes here. And man, thank you so much for coming on. And I think getting us out of a box a little bit.
I know it's a really unique
it is.
Model coming into the property owner space, like the investor space.
Yeah.
Yeah, I appreciate it. And it's fun. It's fun. Like, obviously the biggest thing I'm doing out there is just educating people that, hey, there's more out there than just paying an insurance company, never filing a claim, and seeing your premium increase year over year. And it's really because the network is built that way.
Yeah.
So just getting people that, hey, there's an alternative. And it changes their framework of how do I become a customer for paying for insurance companies to how do I start owning insurance myself? And the psychology of that change and just educating people that it's possible. It's really a lot of fun, and it takes people a while. Insurance is one of those things where it's like, a lot of people who don't like math, when they hear the word, their brain just kind of shuts down. Insurance seems to be that for a lot of people too. So I can't approach it as like, hey, I'm not selling insurance. You're becoming the owner of an insurance company yourself.
Yeah, right.
I think it's a lot easier to help people understand that framework. Because really insurance is it's built a bad taste in people's mouth, unfortunately.
Yep.
So I really have to just change the framing, and it's like, hey, you're not paying for insurance. You're becoming an owner. And just leading with that has been a lot of fun. And I love helping people, right, close that gap.
Yeah.
You get there.
Well, thank you so much. And we really appreciate you spending some time and sharing with us, educating me, and then educating our audience as well. So we'll catch you on the next one.
Yep. Awesome. Appreciate it, guys.
As always, excited that you joined us for another episode of the Reinvest Podcast. If you want to learn how you can use your hard-earned capital to diversify into real estate, go to our website, reinvestcapital.us, and shoot us a message. Move farther, reach higher, and grow deeper.